Or the topic this week is really, this says here, distributions to shareholders, dividends and repurchases. Not exactly the same title as what's in Blackboard when you look at the exact same things there, but it's covering the same topics. Just want to show you kind of how this fits into the big picture. So let's talk about distributions to shareholders first, which is dividends primarily. And this kind of shows you how that fits in. So obviously a company's financial statements are, the income statement is one of them, and that's your sales, less your operating costs, less taxes, minus required investment in capital, basically money you need to invest in yourself to maintain your ability to run your business, maintain operations. And then whatever sources of cash that you may have from outside of your normal sales also, but that boils down to free cash flow. And so with your free cash flow, you have a ton of choices of what to do with it. Obviously, you can pay off debt, pay principal and interest on debt. You can buy more stock of your company. You can invest that money, invest it in investments of some sort, try to get a return on that money while you think of other things to use it for down the road. Or you can pay dividends or stock repurchases. Stock repurchases is buying your stock off the market back. Companies do that quite a bit because they can use that stock then to compensate employees through stock purchase plans. They can also, by doing that, there's fewer shares of stock in the market. You don't pay dividends on shares that you own, and fewer shares in the market means sometimes stock price will go up. Or you pay dividends. So, and of course, you're making a combination. It's not always just one of these options. It's usually a combination of all of them. But the big question is, how much dividend do you pay? And that's really what a big chunk of the chapter is about. When you read the chapters this week, I think you'll see quite a bit about dividends. In just deciding what level of dividends do I pay. In chapter 5, the payout policy chapter, that really comes into play. How do I decide how much to spend on dividends? How much do I keep? How much do I pay out? Just make sure you're looking at that. The nice thing about the chapters is they're really, to me, they're easy reads. Hopefully you're finding that to be the same case. You may not agree, but yes, but they are important to read the chapters, and they kind of walk you through some of the same things I'm showing you right here, but they kind of walk you through once you have your revenues and whatnot, your expenses, then your capital improvements, your cash flow is left over. Just what do you do with it? You know, how much do you keep? How much do you pay out? Those are always some of the tougher questions that companies have to figure out. So distribution policy, basically payout policy, distribution policy. This PowerPoint uses the word distribution. The book uses the word payout. We mean the same thing. Basically, how much cash should go to your stockholders, and then there's really two possible distributions, and we've mentioned that, is to pay dividends or in a combination thereof, buy stock back from your shareholders. Okay, so that's really the two things, the two combinations. You can do one, the other, or both at the same time. And the patterns over time for distribution, you can see here, the percent of total payouts as a percent of net income has been stable, and this is just kind of just saying, in general, what do companies typically pay out? And you can see here the 26 to 28% range is kind of typically where we're at. Obviously, a smaller company, younger companies typically are not paying distributions. They're typically reinvesting any earnings back into the company to grow the company. It's typically once a company kind of matures, has extra cash flows, that's when it begins to do payouts, if that's dividends or stock repurchases. There's three theories behind dividends and how much to pay or what to do with them. We'll talk about all three. The first one, that dividends are irrelevant. Investors don't care about a payout. That's one theory, and of course that doesn't hold true for everybody. The second one is a bird in the hand theory, meaning that investors should prefer a higher payout to get that cash in their pocket, where they can decide what to do with it. Or the tax effect, that investors would prefer a lower payout because they would have to be taxed on those distributions anyway. So the irrelevance theory states that investors are indifferent between dividends and retention generated capital gains. So in other words, what we're saying here is that companies, as they are profitable, as they have earnings, that increases your net income. It increases the worth of the firm because you take your earnings, you reinvest them in new projects, or you put them into literally investment vehicles, stocks and bonds, where you're growing those funds. And either way, the company should become more valuable. So that's one thing you can do with it. Or of course, you can pay out something as dividends or stock repurchases, meaning you're giving that cash back to your shareholders. Through a dividend, you're rewarding your shareholders by paying them something. By a repurchase, you are buying stock back off the market from your owners, and so you're giving them cash also. So the irrelevance theory says, as an investor, let's just say I own shares of stock of a company. I'm indifferent if I receive a dividend or if that money is kept in the company becomes more valuable because it didn't pay any dividends, and I sell the stock when I want to, and then I just get more money out of a capital gain. That's what they're saying. So that's one theory, which may or may not hold true for everybody. Typically, it's different people have different needs and preferences. And the bird in the hand theory deals with investors think that dividends are less risky than potential future gains because a dividend now is certain, right? If a company's paying a dividend, that's money that will go into my pocket, and then I can choose what to do with it. I can keep it, I can reinvest it, I can buy more stock, buy stocks of another company. I can do what I want. So that's one potential. And then that's more certain than if the company keeps the earnings, doesn't pay out a dividend, tries to make the company worth more for future capital gains. We're saying it's more certain that I have the dividend now, potentially than bigger capital gains down the road. And then tax effect theory just means lower payouts means higher capital gains. Capital gains taxes are deferred until they are realized. So if you own a stock and you buy it low, let's say you buy a stock at $100 and you sell it at some point in the future for $150, that $50 extra is capital gain. And that capital gain is taxable. Dividends are also taxable. If a company pays me a $2 dividend, I pay a tax on that also. Okay. So the tax effect theory just says I'm better off waiting and paying the taxes down the road than I am now. Okay. So it says here that research has shown that investors require higher pre-tax returns on stocks in high payout companies, so companies that pay out a lot of their earnings. But taxes alone can't explain the differences in required returns between high payout companies and low payout companies. So what they're saying is that there's no really conclusive evidence for these. So I guess my experience would probably say of the three, some combination of 1 and 2, the dividend irrelevance and the bird in the hand are probably somewhat where we're at. Okay. So let's talk about the clientele effect just a little bit. Excuse me. Different groups of investors have different dividend policies, what they require. And I've kind of alluded to that already. So a private investor just trying to invest for fun, just to see how they can do, or the investor that this is my retirement, or a professional money manager would all have different ideas or preferences for dividend policies. Also keep in mind, past dividend policy determines the firm's clientele of investors. If I'm an investor, individual investor, just thinking I want to try to grow my portfolio as fast as possible, I would probably actually shy away from stocks that pay dividends and try to find stocks that are companies that are smaller but I think will grow quickly. And smaller companies typically don't pay a dividend because they're trying to grow and compete in the market space, and they're typically better off just taking all their earnings, reinvesting them back in the company, and trying to launch new product lines, new services, new locations, and just get bigger and compete with the big guys. So typically smaller companies, you're looking for growth and not dividends. So if I'm looking to try to grow the value of my portfolio, I don't care about dividends, I'll buy smaller companies. Let's say I'm near retirement and I really am thinking more about income and a flow of income coming into my pocket to fund my retirement. Then I'm thinking probably more dividend stocks. I'm going to buy stocks that I think are more stable companies, companies that are blue chip, been around a long time, done very well successfully, and have a high track record of paying dividends. They pay dividends a long time, and they will continue to do so, and I'm going to buy those. So that's what you're looking at. So typically what you do in terms of dividends or not paying them will determine what kind of investor will buy your stock also. And of course, whenever you change a policy as a company, now you may alienate a certain class of your investors. Your investors now may not be happy, so they may buy and sell. So if you did pay a dividend for a long time and all of a sudden you don't, you might have a class of your investors who are not happy with you and will sell that stock, but as they sell it, they might have to pay capital gains tax and of course pay brokerage fees as they buy and sell. So that's part of it too. So signaling or information content, just know, we're kind of talking a little bit about the stock market here, and we live in the age of information. As long as you have a smartphone, as long as you have a laptop or a tablet and a connection of some sort, you can get any information you'll ever need about stocks in a company. And so that's the age we live in, where that information flow is continuous and never really ends. Okay. So anyway, for companies then, as they're signaling, as they're kind of discussing what they're going to do, you can see here, investors view dividend changes as signals of management's view of the future. What do we think will happen going forward? Managers hate to cut dividends, so they won't raise dividends unless they think that raise is sustainable. And that's typically the case, because if we paid out a certain dollar worth of dividends and all of a sudden we cut that back, typically the stock price will come down, and people don't like that. Nobody's happy when that happens because of a dividend policy. Stock price increase, that time of dividend increase, should reflect higher expectations for future earnings per share. So if a company raises dividends, that should come about because we think that the future earnings will go up, the earnings per share will go up. Okay, and that dividend increase should reflect that. Not just because our investors are clamoring for more dividends. So don't be careful about cutting back dividends, but also don't increase them too much in any given year, because you kind of create that expectation that that's now the new base for future increases. Okay, and so the residual distribution model is to find the reinvested earnings needed for a capital budget. And when we use the word capital, we're thinking big ticket, more expensive items here. Okay, so we're thinking things that are going to be expensive. So big ticket, more expensive items. So how much do I need to maintain current operations and maybe just actually still fuel some growth? Any company that's ever been in existence needs capital to maintain and increase operations. Even if you've got a production plant that's working very well, things will break down. Maintenance needs to be done. Some machinery will break down, need to get replaced. New technology will come out saying you should reinvest in better equipment that might be more efficient. Those kinds of things matter. So you have to always have money set aside to reinvest to maintain and grow your operations. And so that's what they mean is, what's that combination that I'm looking for in terms of how much money do I invest in myself versus how much do I let go as dividends. Okay. So my distributions are my net income minus, I have to keep in mind two things, my target equity ratio and my total capital budget. Okay, so there's always a bunch of ratios within finance. We haven't really talked much about ratios in the class at all, But we have to keep in mind the fact that ratios are important and ratios matter, and ratios are a way to analyze financials. And finance people have a goal of ratios need to be in certain amounts to show that the company's performing well. And so we've got target equity ratios to keep in mind. But we also have a capital budget that needs to be financed. And that capital budget is, again, how much do we need to put into ourselves, to reinvest in ourselves, to maintain and grow our operations. So my distribution then is net income minus the required equity needed to fuel and maintain operations. So just a small example here, a company called IWT. They have a capital budget of $112.5 million. A target capital structure. 20% will be debt, money borrowed, 80% equity, which is your retained earnings in your common stock, that you want to maintain that structure. And you believe your next net income number will be around 140 million, and you have 100 million shares that are floating around and outstanding. So here's my equity ratio. It's that 80% weight. That W stands for a weighting, S for stock. And so 100 million shares, 80% weighting. My capital budget needs to be 112.5. That's to maintain what, that financing myself, that investment in operations and growth. My net income numbers are projected to be 3 different numbers. And you can see then what my required equity is. My weighting at times my capital budget needs to be at 90. And my distribution then changes. So what I'm saying is I have to have a capital budget of a certain amount. I have my net income of a certain amount, and that definitely affects my payout. So you can see here then, my distribution paid is net income minus my required equity, and my required equity is 90 in all three examples here, all 3 situations, based on my different net income ranges. And that in some years, or these aren't years, just different scenarios. In one scenario, I've got 50 left over. In one, I've only got 70 left over. In one, I've got nothing left over. And so that changes what my payout ratio is and my dividends. Okay, so that's kind of how companies look at it. Is I have weightings I want to maintain between debt and equity. I've got a capital budget that needs to be financed with money that I'm making, and then my net income, any amount above that, I can dividend away. So fewer good investments would lead to smaller capital budgets, and so hence to a higher dividend payout strategy. More good investments will lead to a lower dividend payout. So what they're saying here is, what opportunities do I think I have to invest in capital projects? Do I see opportunities where I can put more money in down the road that will fuel future growth, or do I not? So sometimes companies will look back and go, there aren't really any good projects that we think are going to be home runs or do really well for us right now. Sometimes then you go just for some smaller things. Sometimes you don't do any capital projects or just do the bare minimum. Some years you're doing some very big things, and obviously what you're doing will impact the payout ratio. So the advantages of looking at a good dividend policy is, what we're saying here is we're minimizing new stock issues and flotation costs. And what the point of that is, as we think about financing new capital improvements, we always have to think through, how do we fund that? And the more we fund from internal money generated, the less we have to go out and get from other sources. And maybe selling stock then is one of those external sources. There's a cost to that. That's what flotation cost means. Flotation here means that's money that a broker will take as a commission. That's filing fees, lawyer fees, things like that, that I have to worry about if I am going to issue new stock. And there's a cost to that. So if I am keeping enough of my own earnings internally that I minimize my external need for financing, what that means is that reduces my cost of getting financing. Okay. Now, the downside with this policy we're talking about here is, and you saw that from the screen a couple screens ago, is I'm saying I'm going to keep a certain amount, and my net income above or below that will then determine the amount of dividends I'm going to pay. And the market doesn't like that. So that's a big disadvantage of that, because it sends conflicting signals. And it puts more risk in your company, especially from the investor's point of view. They don't like risk. They like certainty. Everybody likes certainty when it comes to investments. And if you buy a stock and you feel pretty confident that dividends will be maintained and go up, there's not as much risk in owning that stock. So that's part of it too. So it says here that's a guideline in following dividend policy, but don't be absolutely 100% rigid with it either. Okay. So a little bit too, just I want everybody to kind of be aware of what's the procedure for paying a dividend to. Just, and if you've taken an accounting class at some point or other business classes, you'd be kind of aware of that. But what's just that? How does that happen? How do dividends get paid? And so first of all, a board of directors has to declare the dividend, number one. And they declare a quarterly dividend. In this example, it's 50 cents. That's pretty common that dividends are paid every quarter. So you would say we're going to pay a $2 dividend for the year, but we pay it out every quarter at basically the annual amount divided by 4, which is 50 cents. So declaration date on one day, and then it says on December 12th, that's the day that you'll get the dividend. And so it goes ex-dividend the day after. So we declare a dividend, and typically right around 3 weeks to a month later, we're saying whoever owns the stock on this date receives a dividend. So if you bought the stock on the 17th and own it on the 12th, you receive the dividend. Okay. The 13th is the day you don't get the dividend. Okay, because you don't own it on the payment date, or on the date of record, I should say. The 12th is the date of record. And the 14th and then the 15th happens, so it's 3 days later. Now, as long as you own it on the 15th, you'll get the one, potentially the one after that. So sometimes the stock will trade what they call ex-dividend for 3 days. That's the 13th, 14th, 15th. In other words, there's no dividend with the stock if you own it. If you just bought it on those 3 days, there's no dividend to receive. That's what they mean by that ex-dividend date. And the payment date is the 5th. So if I owned it on the 12th, I get paid for that on the 5th. So we talked too about stock repurchases, companies buying their own stock back from shareholders. I mentioned a few things also here. It's an alternative to distribute cash to our shareholders but not pay a dividend, because when repurchases happen, everybody knows they're kind of whimsical in nature. They may happen one year but not the next. Typically companies don't do them that often. They'll just do a whole bunch at once. So there's not that expectation that there is with dividends. It's also a way to, if you have a lot of cash, maybe you sold off some assets, you've got a lot of cash, and you don't have necessarily a plan to use it, one way to use it is to buy stock back, because that buying the stock back rewards your shareholders. Now you own those stocks again. Now you can do what you want with them. You can use them to compensate employees. You don't have to pay dividends in stocks that you own. That's good too. And you can choose to resell them in the future if you would like to. And that helps you make capital structure changes. So if you want to change your capital structure, that's a great way to do it. And of course, I mentioned too, it's a way to compensate your employees through stock options. So the way repurchases happen, a company, of course, this has to be approved by the board. So once it's approved by the board, the company will announce that we're going to do this. You can have a broker that you have working for you just simply buy the stock over time. Just buy it off the market and just say, here's a pile of cash, begin to make purchases. You can make an actual tender offer to your shareholders. You can say to your shareholders, we want to buy the stock back. Whoever responds to our offer first is who will take up on this. Or you can make a targeted repurchase. You can go to somebody who's a very large shareholder and say, we'd like to buy your shares back from you. They don't have to complete the intent of doing this either. Once they announce they want to do this, there's no requirement that they do this. I mean, when these plans are in place, money typically is set aside, the board approves it, but if something changes before this happens, you can change your mind. You can move on to other things too. Now, the key here is the stock repurchase at the time it happens does not affect stock price. It's more of a long-term play. Companies are worth what they're worth, and so there's fewer shares of stock, and the company becomes worth more. Over time, the stock price will go up. But at the moment it happens, it does not affect stock price because when the company's paying out cash, it has fewer assets, right? So assets are leaving the business, which affects the value of the company at the same time that you're buying stock back from your shareholders. So that combination of what's happening basically says there is no effect on stock price. Okay, the actual repurchase itself has no impact on stock price. Now, over time, yes, you could probably make an argument that yes, stock price should go up because there's fewer shares of stock that represent the same value of the company. So with the repurchase, stock price doesn't fall at time of repurchase, but the number of shares outstanding falls. With the dividend distributions, though, the stock price will fall by the amount of dividends at the time of payment because of the ex-dividend date, but the number of shares that are floating around and owned doesn't change. So over time, though, how does this impact dividends? Repurchases over time will actually affect dividends. I meant affect stock price. Dividends, let me say that again. Stock price over time will go up more for repurchases than they will for dividends. So with a repurchase, what's nice is your shareholders can decide if they want to be involved in this. Nobody makes you sell your shares. You can choose not to if you don't want to. Helps avoid setting a high dividend amount that can't be maintained, right? Because we create that expectation once we begin to pay dividends. Income received in capital gains rather than higher tax dividends, the capital gains rates are a little bit lower. And stockholders may take this as a positive signal and think that management thinks that the stock is undervalued. So that's part of it too, is when companies announce repurchases, there's typically the belief that the company thinks its value is undervalued on the market, so stock price over time does tend to creep up. Disadvantages may be viewed as a negative signal. In other words, the company doesn't know what to invest in. It's not using that money to invest in projects that will ultimately make it worth more at some point in the future. So that's part of it too. Now, again, with setting dividend policy, just a couple things to think about. You have to think over long term. Anybody in finance at the corporate level has to think very long term. And 5 years is a good time horizon to think about. And to think about what do you want your capital structure to be. You have to estimate what your annual needs are to reinvest in yourself and then kind of pay out dividends from there. So it's always that plan of your target capital structure, how much money you need to invest in new projects, what are my growth opportunities to invest in myself, and then setting a policy for dividends that can be maintained going forward. You don't want to cut them again. You want to make sure that they go up. And then what this slide is basically just saying, so we're moving on to a new topic, I should say. So this is the next chapter, chapter 6. And chapter 6 deals with mergers and acquisitions. And the key thing about a merger and acquisition is how much is a company worth? That's really the big question is, as I acquire a new company, I have to think, how much is that worth? Okay, and that's really what they mean by here. So we have to value the worth of a company. There's a couple of ways to do that. Essentially, in finance, what we say is the value of a company is the present value of all future cash flows. Okay, so we could look at free cash flows of a company generated over what we think the foreseeable future will be, bring that down to a present value today. Or we could focus on dividends and do the same thing. So we can say, what's the dividend payment stream? What do we expect future dividends to be? And we could bring that down to a present value today also. So free cash flow and dividends are ways to value a company and say, what's it worth based on the present value of those future cash streams. We also have to think, though, about a company's mix between stock and debt, the debt to equity mix. That comes into play, too, as we value a company. Okay. So valuation. Of course, with common stock itself represents ownership of a company. Ownership implies control of a company, and through a corporation, stockholders have control because they elect the board of directors. The board of directors then hires management and holds upper management accountable to accomplishing certain things and making sure that the company's plans are being carried out, making sure that the company's policies and procedures are being carried out, and so on. So basically, it's holding the company and management accountable for the plans of operations to grow the company in the future. And of course, upper directors, upper management hires middle and lower management, and so on. And really, managers for a corporation act as agents for the shareholders, and their goal in finance is to maximize stock price. So really, I want everybody to walk away from this class thinking one thing, that the goal of finance is how do companies figure out how to maximize their value, maximize stock price. So I've alluded to a few of these things here. We can value a company based on free cash flows, and of course cash flows can be constant or non-constant. We can value based on dividends, same thing, they can be constant or non-constant, and we can also value them using what they call multiples of comparable firms. So we can find companies that are like ours and say what are they worth and do what they call a multiple of earnings approach. So free cash flow is probably the most common. Free cash flow because every company you can get its cash flow number. As long as it does produce cash flows, companies can have negative cash flows too, but that's a number that will apply to any company. You can do this for any company no matter what. So it's kind of the method that most people will use. And what you do is you take all these future cash flows and you bring them down to the present value based on the weighted average cost of capital, which is the rate of return required by a company's investors. And so I'm not trying to give you big ugly formulas in the class, but we'll just look at a few every so often. And so what they're saying here is the value of the operations of a company, that's the VOP, value of operations, is the sum, and this is the sigma sum symbol, infinity up here and time 1 today. So time. So infinity and time. So what we're saying is the value of operations of a company is the present value of all future cash flows divided by 1 plus the WACC to the power of time. Okay, and that's for forever. So we just assume the company will be in operations for as long as we can figure it out. Okay, and sources of value, of course, for most companies is its operations. What does it do? Pick a company. Let's say Costco, for example. What does Costco do? Costco buys goods, merchandise from suppliers, a whole bunch of suppliers. Those goods are transferred to Costco stores where you and I walk in, we pay our membership fee, you and I walk in, we buy those goods, we pay Costco on the spot, we walk out the door with a cart full of stuff, right? That's their operations, that's what they do. That should have value. So the sources of value is their operations. What does that operation do? Well, every company also has non-operating assets. If you're profitable, you have a lot of cash, you'll take that extra cash and you'll park it in investments just to just for a rainy day type of fund, so you get some extra interest and dividends from that. Maybe you own some other companies or a small share of other companies also, which is very common. And maybe you have some non-operating assets, some property, plant, and equipment type things too on the balance sheet. So the vast majority of your value is operations. Everything else is going to be typically small compared to the value of your operations. So who has claims to corporate value? So once you figure out what a company's worth based on the present value of future cash flows and its current assets that it has on the books, you also have to think about who has claims to those assets. There's always going to be somebody who has claims to those assets. And in this example, debt holders, right? Anybody that has lent money to the corporation, so banks and bondholders. They're number 1 in line. Second is your preferred shareholders. Then anything else that's left over belongs to your common shareholders, who truly are the owners of the company, because the common shareholders elect the board of directors. Okay, and this is just showing you again that value of operations is all these future cash flows discounted down to today, and just showing you some of the steps that go ultimately into the formula we looked at a couple of screens ago. Okay, so the value of operations today, time zero is today, is the future value is all free cash flows divided by the WACC minus some kind of a growth rate. Okay, minus some kind of a growth rate. And so we're going to do an example here. So we're going to say that today this company has free cash flow of 24, time zero is today. The discount rate, the weighted average cost of capital is 11%. We think that free cash flows will grow, and that's a very common assumption. So we're going to go back here and go, we know what they are today, but we have to plug in some kind of a growth factor. Okay, and it's very common that you would look at a company and say, it should grow. Free cash flow should grow as the company grows. And even if it's not a huge number, a lot of companies will grow just as the U.S. population grows. You know, if you say the population grows by 2 or 3% per year, it's not uncommon that a company would grow at the same rate. We have some short-term investments, some debt, preferred stock, and shares of stock of 10 million. And so we're going to plug in our numbers. We're going to say, okay, the value of operations is free cash flows today, which we know is 24 million, times 1 plus the growth. Because go back here and say this says FCF1, which is 1 year from now. And we're going to come back here and go FCF1 is FCF0 times 1 plus the growth rate, divided by the WACC minus the growth rate. And so that's how I get what my operations is worth. I'm saying it's worth 420 million. Okay, so that kind of takes into account what I know today, future growth, and the discount rate. Now, obviously, what that growth really is, nobody really knows, and that's where this becomes a little bit subjective. But, you know, I can look at past growth, what my plans for the future are, and use all of those to kind of help me figure out if that should make sense. So the value of a company then is the value of the operations plus other assets. They made it simple and just there's 100 million of short term. So the value of the company is now 520. The value of operations from free cash flows, all in the future, to also add that the value of assets we own today. And then you subtract debt owed to others. You subtract preferred stock value, and that leaves you with what's left over, the value of the company's equity, 270 million. We divide that by 10 million shares, and then we think the stock is worth $27 per share based on that free cash flow. So if I'm a company and I'm trying to buy another company, I'm valuing that company on the free cash flow method, this is how I would do it and say, okay, I think they're worth 27, and that kind of becomes your starting point for negotiating what you pay to buy the company. Okay. So typically you're picking a growth rate. Now it says here what we can also do is we can forecast sales to grow at a chosen growth rate. It says here forecast net operating profit after taxes, your NOPAT, and total net operating capital as a percent of sales. So that's one way to do it also. I can just say my sales will grow at a certain number, my profit will grow at a rate, and my need for working capital or operating capital will grow at a certain rate of percent of sales also. So here's what we're doing. We're going to say sales are 2 million. Net operating capital is 1,120,000. And then we're going to say our profitability ratio is 4.5%. Our capital needs requirement ratio is 56%. And we've got a target weighted average cost of capital of 9%. So I can take those numbers and project them forward. And then just build various scenarios to see here's what my cash flows will end up being. And what's kind of nice about that is you can build a spreadsheet with many scenarios to kind of help you say, what if this, then what? You know, what if sales are 10%, then what? What if they're 8%, then what? In this example, we're going to say, well, what if sales are going to grow fast, but then level out, you know, 10, 8, 5, and then just be 5% a year for the future. That's one way to do it too. So this way kind of helps you think, well, I know that the current sales, I'm expecting big increases, but future sales may level up. That's very common too. Another way is to do what they call the multiples method, and using stock multiples or price multiples, and basically saying, as you look at valuing a company, it's not unusual to say it should be worth a certain multiple of its earnings. And that's how a lot of how private companies are valued at, is you look at a publicly traded company that's in the same industry, and you can calculate the multiple of earnings that the company is worth, and you can kind of say, let's just transcribe that down to a private company and say, I'll pay you a multiple of price to earnings. So PE stands for price to earnings, price per share divided by the earnings per share. And you just offer based on a multiple of earnings. Okay. You pick a measure of some sort. It says here the market value of the company then is the number of shares multiplied by the value of price per share. So it just plus you're adding back the value of debt. So you pick a measure. EBITDA is for earnings before interest, tax, depreciation, amortization, sales, customers, hypo, whatever that is. You're picking some kind of a measure, and you're calculating the average ratio for something comparable. So I could look at a private company and say, what's the multiple of your EBITDA? What's the multiple of your sales? What's the multiple of your customers? I can find a publicly traded company where I can get the same data and make an offer or a valuation based on the comparable of what that ratio is for another company to another company. So it says to find the entity value of the firm in question, so multiply the firm's sales by the value divided by sales multiple, and so on. So it's a great way to do valuations for private companies where you don't have all the information you might have for a public traded company. That's where it becomes very popular. Now, there's challenges to it. No method's perfect. It's hard to find comparable firms sometimes. Sometimes companies are really big and they've got several divisions, and we don't know what the financials are per divisions. That can kind of muddy up the waters a little bit too. And it says the average ratio for the sample comparable firms often has a wide range. So that's the hard part too. If I am looking at a private company, but I find maybe 5 or 6 public companies that do the same thing, maybe their ratios are all over the place. You know, there's a range of 10 to 50. Which one do I use? You know, how do I figure that out? So that's part of the negotiating process. If you are looking to buy a company, you have to kind of go through that process and figure it out. Okay, so a lot of reading this week because there's 2 chapters. There's kind of more than normal, but just really do your best to read the chapters. What I've discovered towards the back of every chapter, they do kind of a Q&A that kind of just, the author lists a series of questions that I think are always usually pretty good. They're in italics, and they've got a couple of paragraph of answers, and the back of chapter 6 does that pretty well. About the last 10 pages roughly, maybe not quite that many. I think those would be good to read through. I've read through those a couple of times just to get a feel for what they're talking about there, and it's pretty good. So I would say for sure read that back part of it, because they kind of summarize a lot of what's in the meat and potatoes of what's in the chapter on those last few pages. Hopefully it all made sense. There's more this week than there has been in the past because we're looking at 2 chapters. But I'll do a separate recording and talk to you about the assignments for the week. If you have questions about the material, just let me know. Thanks.